uranium prices don't have to go higher from here. They might, but they don't have to. And history suggests that a little more correction is likely. But now, with Kazatomprom sort of doing a rug pull here, I don't think anybody really knows. We all have models, but it's only a model, right? Nobody really knows what the balance is going to be this year. But there are pounds we were counting, a lot of them, that were in the models that are now not there. And frankly, with Kazatomprom producing less, never mind the models and the guidance, but with them actually producing less in 2023 than 2022, I think it's quite reasonable to question whether they can even hit any growth this year at all. Like, they need to make up for last year. So this is a game changer. This is a big deal.
Hey guys, Capital Cosm here. Before we start this video, I just want to let you know that I believe that we are on the cusp of a major uranium bull market. Now, these things don't happen every other week. The last uranium bull market peaked in 2007, the one before that in 1978. So when these things happen, you've got to take advantage of it. And how explosive are they? Well, you've all heard the stories. Uranium skyrocketing from $10 to $20, all the way up to $150 in these uranium bull markets. Where will it go this time around? Well, we don't know. We'll see. But you've got to take advantage of the opportunity. What better way to do that than to leverage Justin Hune's Uranium Insider newsletter? You get access to his monthly newsletters, his webinars, his stock picks, his portfolio, all of that stuff. You get access to guests that you may not see on YouTube. You get access to having them ask questions that you may not see anywhere else. So I highly recommend, if you're going to take part in this uranium bull market, you check out Uranium Insider. Link is down in the description box below. Be sure to click the link. There's quarterly plans, there's annual plans. So if you're kind of tepid, you're kind of hesitant, you could always go with the quarterly plan. Kind of test things out, sample things out, see if you like it or not. But the way I see it, guys, you've got to pick the right stocks. A lot of these uranium companies are not going to make it to the other side. Now, and Justin Hune's uranium portfolio has outperformed the likes of URA by a significant margin. Since 2019, it's up 5x from where it started. So click the link down below and we'll get started right now on the video. Thanks, guys. Hello, guys. Welcome to Capital Cosm. Today, I have a returning guest on the show, a fan favorite, Lobo Tiggre, the wolf of not Wall Street, but the wolf that eats bulls, or supposedly so. Isn't that right, Lobo?
Well, it seems to be my role in the resource sector to be the official raid on the parade whenever it gets irrationally exuberant.
And yeah. We saw that in the last interview you and I conducted. Give a very sobering view of things, and I'm sure we'll touch on that very shortly. But before we get started, nothing in this video is financial advice. Neither Lobo nor I are financial advisors, so please do your own due diligence. With that said, Lobo, I believe the audience is very familiar with who you are. So, you can kind of go over a very brief background for those who may not know, but give us an overarching, very generalized view of the markets, in your opinion, so far for 2024.
Okay, so the 30-second intro is for almost 15 years, I was Doug Casey's due diligence guy at Casey Research. I helped him research and write his International Speculator, RIP. In 2018, I went independent. I'm now the independent speculator. And by the way, Doug gave me his blessing for that name. It's obviously a riff off of his International Speculator. So I've got now, sort of hard to believe, but a couple decades under my belt and network in the industry and really lots of hard knocks along the way. School of Hard Knocks is the best teacher, which connects to the intro remarks we were making. People get all excited about whatever the flavor of the day is or what's hot, and that's fine. But it is always wise to remember that markets fluctuate. As far as the outlook today, I'm sure we'll get to our favorite yellow metals. The overall view is, I don't remember exactly when we spoke last, but assuming it was 2023, I had been saying that it was likely that not just the global economy, which is fairly obviously in recession, but the US economy would become undeniably in recession, and probably by the end of last year. So I have to say up front, I was dead wrong on that, at least as far as the undeniably part goes. Even mainstream economists and analysts will say that, that there may have been something of a rolling recession, they like to call it. The way I see it is, for much of the last year and before, we've had red signals flashing all over the economy. And it's been this one pillar of the supposedly strong laborer consumer. And everybody keeps pointing at that and saying everything's fine. But if the laborer keeps his job, even though the economy doesn't really justify it, that actually sets you up for more pain later down the road. If he keeps spending because he thinks he has a job that's secure, but somehow he's charging up more credit cards and defaulting more on those credit cards, it suggests that really all is not well in Mudville. So really, I'm not going to make excuses or beat around the bush here. I think the audience is familiar with this general thesis. I'm doubling down. I think my basic view is still correct. It's been put off, post-pandemic labor hoarding, and probably the one variable I really didn't account for well was how insulated not just institutions that took out low rate loans, but households that had low rate mortgages and could tap into the equity in their homes and things, how that would insulate broad sectors of the economy from the Fed's rate hiking. Now, insulate doesn't mean make immune. And I do believe we're seeing cracks now in that. And like I say, I'll either be right or I'm wrong. If I'm right, we're going to see undeniable recession in the US this year. I think probably by mid-year, possibly if the Fed breaks something else sooner than that. Sorry, I'm going on very long here, but just real quick, I found it particularly notable amongst all the predictable things that Powell said in his 60 Minutes interview Sunday night. The one thing that I thought was a surprise, if not, just a momentary lapse in going off script, was he said, and when he was asked about the commercial real estate problem, he admitted, yeah, that's going to be a problem. And then he said, not just, oh, there might be some, he said, we're talking to him, it'll be okay. But he said, not just there will be some problems, he said, certainly, the Fed chairman said, certainly, there will be small and mid-sized banks that close or get merged out of existence. So, plural. Certainly there's going to be more trouble in the banking sector due to the commercial real estate thing, if nothing else. I thought that was really striking. And it's the kind of thing that would make for a Powell pivot, whatever you want to call it, if nothing else goes bonkers. So, long story short, I think I'm right. I think it'll become undeniable. But if not, the mainstream view, the talking heads on financial media all over the place, they're still talking mostly soft landing, which is still a recession, which is consistent with the slashed gloomy guidance we're getting from bellwether companies. This isn't just my crazy anarchist disciple of Doug Casey rantings. This is Wall Street. Their guidance is telling us that the economy looks weak. So even if I'm wrong, I think I won't be drastically wrong. And in that environment where the Fed will either cut a little or a lot, it's very bullish for gold or monetary metals or safe haven assets, however you want to look at it. And then I still think that instead of going, through the years of misery that we normally should to correct the market's excesses, I think the powers that be open up the money floodgates. We get another reflationary boom. And so ironically, the same way the markets see bad news as good news, I think this bad news for the economy will, on the other side of the hump, be good news for commodities writ large as those money helicopters fly. Sorry, that was a long answer, but it was kind of a broad question you asked.
Yeah, I want to dig into that comment you made about Powell. Effectively, what Powell's done in a weird way is he's cut rates without cutting rates. And so what do I mean by that? Just the actual microphone or megaphone that he has to put forth his desire to cut rates has actually propelled the markets even higher without even doing so. So he's using his platform as Fed chair to accomplish that without even doing anything so far at the moment.
Just the way they tightened using the markets as well. This is not an accident. This isn't a conspiracy theory. He said that their guidance, his jawbone, is one of their policy tools. I mean, that's why they do the dot plot. They're trying to not just manage by moving the interest rate, but by their by their jawboning. That's part of their toolbox now. So yeah, I think you're spot on.
Yeah. So what are some of the tool sets that you use to kind of make an assertion whether or not we would have a recession? Like, what are the metrics that you look at there?
Well, people like to say, oh, well, you just, by definition, even if everything else is in the red, you can't have a recession if the labor market is strong. I don't think that's true. You can have people working in jobs, if you have former software engineers from all these tech company layoffs we're hearing about flipping hamburgers now, we may still have full looking employment, but it wouldn't be as productive. If you have high paying jobs turning into gig work, part-time work, or just, lower level jobs because you've got a family to feed, that is not a step in the right direction. I like to give the example that in the Democratic Kampuchea, anytime they call it democratic, it isn't. Every time they call it the People's Republic, it isn't, right? That was a communist dictatorship of the worst order. And it said right in the Constitution, Pol Pot put it in the Constitution that there was no unemployment in Kampuchea. And he was right. If there was somebody standing around not doing anything, they sent them out to the rice paddies at the nasty end of an AK-47. They put them to work until they were no more. So there was no unemployment, but that didn't make for a thriving economy. So what I'm saying, you asked, what am I looking for? Well, we had a freight recession, we had an earnings recession, we had a manufacturing recession, we had a recession in so many things. We had a commodities recession, except that labor market. So I think it's wrong to just define everything as fine because of that. I think the GDP statistic is deeply flawed. But that having been said, I think things can, they can pretend until the labor market falls apart, because that's a lot of voters. They get upset and things have to change then. So I am looking for the labor market to turn, and it has started to show cracks. And this is one of actually the most reliable predictors of recession, is that, of course, you have higher unemployment during recession, but it turns up going into the recession. And we have seen upticks in unemployment. If the last number was flat after revision, but actually the U6, the more inclusive number, was up again. And if I recall correctly from what Danielle DiMartino Booth said, if you had adjusted for the labor force participation, even the regular headline unemployment would have been 4.1%. So we're definitely seeing cracks in that labor market. I do think that's important. It may lag because of that post-pandemic labor hoarding even more. But if those other signs, like the credit card defaults, the car loan defaults, or even just the credit card balances, if those are telling us that the labor or consumer is in more trouble than it looks, we should see the fallout soon-ish. Basically, I'm saying is I'm already starting to see what I'm looking for. And again, either I'll be right or I'm wrong about that. The numbers should start to show more in the labor market soon. And that's without a central bank, or sorry, a small to medium-sized loan bank problem with the commercial real estate or anything else breaking.
Yeah, yeah. So, I mean, I see exactly what you mean there. We do have the yield curve inverted. Typically, a recession doesn't start until yield curve uninverts. We still haven't gotten to.
It has been disinverting, and in fact, it's late. And there's some of these things, you're asking me, and I mentioned the question, but the full context is we really are in uncharted waters. Mm-hmm. So I'm giving you my best guess, but I don't know. Powell doesn't know. Yep. Nobody knows. Not even Rick and Doug know, right? It's this is a 100-year event, a distortion of the economy, in an economy that's radically different from what existed during the Spanish flu. And so you just can't say this is what's going to happen. We were already seeing things that are different. So to your point, though, like the yield curve inversion to disinversion, by that metric, we should have been in undeniable recession already. The other one that's even more late is the leading indicators, that is a flawless predictor, but it's way late now. Like, we should have been deep in undeniable recession by now, according to that metric. So there's people that are throwing it out. They're saying, oh, well, it didn't work this time. I think that's premature. The other sort of, I think the backbone here, the thing that really, or the number, if you will, around all of this will rotate, is that the long and variable lags, everybody talks about that, jokes about it, dismisses it. But the fact is, the long and variable lags, depending on which numbers you use, take 18 to 27 months on average to show up. That means there's times where it takes more than average, and we're not in an average situation. So by those numbers, we would start to worrying about it getting beyond average by this summer. We're not even there yet to where you can say, oh, well, if the long and variable lags haven't showed up yet, they're not going to show up. That's simply just not true historically.
Yeah.
But going beyond this summer, the longer we go, the more weight there will be to, well, this time really does look different. But we're not there yet. And even if you get beyond average, remember, it's an average. You'd have to get to the end of this year with nothing blowing up or without serious signs of recession to be able to say this time really was different.
Yeah. And correct me if I'm wrong, using the classical definition of a recession, we would have already been in a recession last year, no?
Well, that was 22. And
22,
it's not
yeah, sorry.
classical definition if you mean the 2 quarters of negative GDP. So you could say, yeah, we had a recession, but you know what? It's not useful to quibble with words. Like, if we want to say to the team soft landing folks, or even the team no landing folks, oh, well, we did have a recession. We had 2 quarters of negative GDP. They could say, well, yeah, but the economy has grown since then. Look at the stock market. So if your thesis was, buy gold, head to the hills because we're going into a nasty recession, and you did that in early 22 because of those 2 quarters of negative GDP growth, you would have missed out on the Magnificent Seven, so-called, and all these other opportunities to make money. And, opportunity cost is a real thing. And too early as an investor is wrong. So I don't want to dismiss that. I want to make excuses and say, oh, well, yeah, we had a technical recession. No. I think the reality is, the consumer is still spending. People are still holding on to jobs that I think they shouldn't. And it's not that I want misery. It's not that I want people to get fired. But if a large business, say, really can't justify holding its entire workforce in place and should say cut by 10% to make sure it remains a going concern, and they don't because they're afraid that if they fire people, they won't be able to get them back, they actually exacerbate their problems. They increase the chances that they're going to end up firing 100% because they go bankrupt. So if you don't do that, you're running a serious risk of making things much worse. And it's the surgeon who amputates a leg to save the life. It's not a pretty thing. It's not anything anybody wants to happen, but under those circumstances, it's the right thing to do.
Yeah. So let's go ahead and take it. You mentioned the yellow metal. You know exactly what that means. Not gold. I don't think you're mentioning gold. I think you're referring to uranium. Uranium's been talk of town, like you alluded to. There's a lot of chatter on uranium. We're sitting at about, last time I checked, we corrected down from $107 down to $102. So some interesting volatility there with uranium. But despite that, uranium continues to be, at least on FinTwit, on Twitter, I know that's not necessarily a good reflection of retail sentiment as a whole. But what's your general take on uranium at the moment? We had the big.
Oh, it's hot, brother. It's still hot. It's not just UTwits. It's the Vancouver Resource Show, even though it covers all kinds of resources, is pretty much a gold bug show. But people were talking about uranium. They had not one, but 2 panels and all kinds of uranium companies there. I'm wandering around the gold booth hearing people talking about uranium. The buzz was quite strong. And so, going to our initial point, I was the rain on the parade. If you look at the Vancouver uranium panel, I said so. And I said that, look, I'm a bull. I'm not just a multi-year, but a multi-decade bull for uranium. I get it. This is an idea whose time has come. It's got the green mantle of approval now. Europe is pushing for small modular reactors. There's all these bullish reasons to be optimistic about uranium, but the price had just gone like this. And I said, look, no price can go vertical forever. And that was just before the correction. Now, people have gotten very mad at me for saying this. Oh, you're talking uranium down, blah, 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 you're turning a bear. And I just think that's, there were people that were very optimistic about uranium just going straight off to the moon in 2021. And people who listened then and bought 52-week highs then have been screaming bloody murder for the last 3+ years now, because uranium went, corrected and people got hurt. So I don't want to tell anybody to rush out and buy a stock that's just hit a 52-week high or a multi-year high. And I was right. Okay, technically, it hasn't corrected 10% to meet that definition, but 6-7%, that's a significant downturn. It was the biggest correction in a year for uranium. And some of the stocks that had hit multi-year highs corrected more than that. So, sorry, but I just don't think I was wrong to caution patience, prudence, not to chase things. That doesn't mean I'm a bear or that it's done. Nothing about the thesis has gotten worse. If anything, it's gotten better. What we didn't know then, but we do know now, is that Kazakhstan, Kazatomprom, some people were warning that it wasn't going to be able to meet its increased production guidance. Justin Hune, the uranium insider, Professor Quakes, others we all know and love, they said this, and hats off to them. They called it. But until Kazatomprom admitted it, it was deduction or maybe induction or just, speculation, if you want to call it that. Now it's a fact, and that matters, right? Kazatomprom didn't just slash their guidance for this year and call next year's into question. They actually produced less uranium in 2023 than in 2022. So, hats off to Justin. He was flat out right, it looks like, about everything. But now it's not just Justin saying so, it's Kazatomprom admitting it. And when that happens to the world's largest and lowest cost producer, that's really material. So whereas if you had asked me just, a week or two ago, I would have still been saying, look, triple digit uranium, it's great. I'm a happy shareholder of all these companies, but that's way above the incentive price. And there's mines being built now. There's new sources of secondary supply. Nobody knows how the balance is going to be in 2024. Uranium prices don't have to go higher from here. They might, but they don't have to. And history suggests that a little more correction is likely. But now, with Kazatomprom sort of doing a rug pull here, I don't think anybody really knows. We all have models, but it's only a model, right? Nobody really knows what the balance is going to be this year. But there are pounds we were counting on, a lot of them that were in the models that are now not there. And frankly, with Kazatomprom producing less, never mind the models and the guidance, but with them actually producing less in 2023 than 2022, I think it's quite reasonable to question whether they can even hit any growth this year at all. Like, they need to make up for last year. So this is a game changer. This is a big deal. I had been, when I was looking forward to my projections for 2024, I got a lot of people in the uranium boat angry because I said, okay, my favorite commodity this year is gold. I was right about uranium doing great in 2023, but I think it's going to be gold in 2024. I have now moderated my outlook. I think this Kazatomprom thing is important enough that it limits the downside. There's potential for flavor of the day upside in uranium. And so, but I'm still, for all the recession reasons we were talking about earlier, I'm still uber bullish on gold. So I'm actually bullish on both. I know people don't like a tie, they want one or the other, but
you're bullish on yellow metals.
I like both yellow metals. And here's one more thing of beauty. You can criticize me for being wishy-washy and not picking one, but there's an upside to being bullish on both. And that is, uranium is not a precious metal. It's not a safe haven asset. It's an energy commodity, but it's one that's recession resistant because it's used for baseload power. And it's in the structural supply deficit now and the demand, all this other stuff. So I see uranium as recession resistant. But here's the thing. If I'm just flat out wrong, and never mind team soft landing, let's say team no landing is right, and everything is peachy, everybody's happy, the Middle East, the Hamas and Israel kiss and make up, and so does Putin and Zelensky, and everything's fine. There's no more fear in the world, and safe haven demand just makes gold plummet, right? Let's say, obviously, I don't think this is likely, but say I'm dead wrong about gold this year. In that world, the price of uranium should skyrocket because it's off to the races,
They
and
hit
it's
each other.
already in short supply, right? So I think a two yellow metals portfolio has a bit of a hedge, not a bit, I hate mincing words. I think it's self-hedging in a significant and material way, but I actually expect both to go up this year.
Yeah. Yeah. I mean, that's kind of the same thing that I practice as well. I actually, when I first set up my commodity portfolio back in 2020, I want to say I had no idea that we were going to reach these heights so quickly with uranium, whether or not coal was going to spike up in 2022, natural gas was going to spike up and but I did own uranium. I did own battery metals. I did own coal because all these different commodity plays, like you mentioned, hedged themselves as well as gold in the mix as well. So it's definitely something to consider there. You mentioned Kazatomprom cutting their production target for 2024 and even missing 2023 production targets as well. So you're already dealing with a shortfall. Just yesterday, we heard the news that the president.
Sorry, it wasn't just a production target. They produced less, not a lot less,
Right.
but they produced less. I mean, the actual uranium produced was less than in 2022.
Yeah. So they produced less than in 2022. And then to add fuel to the fire, no pun intended there, the president of Kazakhstan fired his entire government yesterday. So what is there any significance there as it relates to the uranium market or what? What's your prognosis there?
Well, any instability is obviously a concern. I'm not dismissing this entirely, but A, it's not uranium related, and B, it's not like, the headlines were the government of Kazakhstan quits. Well, not really. The president's still there. The guy who's in charge, the guy who called the Russians in when people complained about too much inflation, Russian army, I mean, right? He's still there. So, I don't see a big change. It seems unlikely that this is going to cause anything material. And by the way, when there were riots and he called the Russian army in, that didn't do anything for uranium prices. Right? Not a lot. I don't.
Right.
I didn't even remember the numbers, but I don't think it was material.
Yeah,
So
we were still in that consolidating phase.
that was a much more, I think, serious concern than what just happened now. This is politics. He's already got a temporary person in. He'll name a new prime minister, and things will go forward. I think what was more interesting is that, and I'm not an expert on this. I'm not an expert on Kazakh politics, but from what I read on the news, the people who resigned objected to reforms that were supposedly meant to attract foreign investment. Now, if that foreign investment means opening the doors wider to Russia, that could be significant in terms of more pounds heading or staying east rather than coming west. If that was a broader world attraction to investment, it could be good for mining companies in the West. Like Cameco has a toehold in there, but other companies would like to have access to those, world-class resources as well. So again, I don't know the details, so I can't pontificate on this. But the idea of them trying to attract foreign investment, depending on who that is, could be a plus or a minus.
Yeah. Yeah. So keeping it on uranium for now, you mentioned that uranium may have run too hot and we could see some downward pressure. Is that what your summation was?
That was my view a month ago.
A month ago, but now
well above the incentive price, right? The lowest cost development projects are in construction, if not going into production now. There are some leaving the pre-production sweet spot. There are some struggling for financing to go in. There's others, working their way through. Like high prices are in the process of curing high prices right now. But then the Kazatomprom rug pull happened. Like that was not in anybody's model, maybe Justin's. Um, but so I am now. I would stand by my statement that nobody really knows what the balance is going to be this year. We're all guessing. You call it a projection, you throw some math at it. It's still a guess based on assumptions.
Yeah.
So nobody knows, but I'm now much less worried about it. I think that the low hanging fruit that's being brought online now will not be enough. Actually, we have a free uranium report on our website. We had already, before the Kazatomprom thing, we had said that the development projects and the big producers that have mothball production, Kazatomprom and Cameco, even if all those projects came online or back up to nameplate capacity, that wouldn't be enough. It was the secondary supply plus those things coming online that I was worried about causing a brief oversupply in 2024. So with Kazatomprom, it's a huge shift. It's something like 9 million pounds that just aren't going to be there this year. So with Kazatomprom's change, I no longer think that secondary, like even if, the DASAs and the honeymoons and all these other projects come online, right? That happens. And even if Cameco can ramp up McArthur River and as much as they hope to, and some of the secondary supply from miners who bought pounds to sell later, I don't think now that that's going to be enough to make up for what Kazatomprom just took away. So that makes me much more bullish now than I was just a few weeks ago.
Mm-hmm. Yeah, not too long ago, I actually interviewed a few well-known TA chartist guys, and we were looking at the uranium price and the hockey stick pattern that it made that you kind of mentioned before. And they kind of came to the conclusion that we were running a little too hot, and there would be they saw a pullback in the cards because of that. My question
I'm
is,
not a TA, it wasn't the hockey stick. It was that we had gone way above the incentive price.
Right.
So therefore, you could see that was incenting market players. Like you could see the production coming back. That was my concern as a fundamentalist.
Right. So I mean, that kind of ties into my question is that how applicable is TA to a market like uranium that's so predicated on the fundamentals like you just kind of laid out there? Like does TA apply to the same degree as, let's say, other commodities do?
Boy, you really like to ask questions that get rotten tomatoes thrown my way, but I'm not a TA. I don't use a lot of TA. I mostly use it for buying and selling, setting price targets and looking at the chart, looking at the data. What is a reasonable entry or exit point? What does this particular stock or commodities trading data tell me, right? In terms of, where the market's going to go more generally, I'm just a fundamentalist. But I will say, I just talked to Gareth Soloway recently, and he's bullish on uranium. So that's one technical analyst, highly regarded, who's very bullish. And the other thing is, even every TA I say, they never say, oh, this proves that we're going up or we're going down. They just say, well, in this pattern, typically it will go up or it will go down. They never say never. And you could see a big surge like this and you think, oh, well, that's the head on a head and shoulders pattern. And so the next leg is likely down or whatever the pattern is. And then it turns out it goes the other way. And so, no, well, it turns out that head and shoulders, that was all just a bigger shoulder of a larger head and shoulders pattern, right? Or something like that. So I'm not trying to make fun of my TA friends. I'm just saying that I think they wisely say, look, this is a matter of probabilities, not certainties. A pattern like this probably means this, but it doesn't necessarily mean that. And I think the better ones, they don't operate in an absolute vacuum where they refuse to look out the window of their model and look at what's happening in the real world. So if you have, game changer news in the real world, like when Cigar Lake flooded and contributed to the big spike in 2007, that was something that happened in the real world. It wasn't going to be in anybody's models, and it certainly wasn't going to be in anybody's TA lines on the charts. And
it wasn't priced into the charts. Yeah, exactly.
Right. And there's no, and I understand that conceptually TA is trying to bring in the wisdom of the masses. Like neither you nor I nor Gareth nor anybody is smart enough to figure out the entire world economy. But looking at the price action, you're looking at the collective wisdom of thousands or millions of investors. And the patterns in that are telling you something. I understand that, and that makes some sense to me. But that collective wisdom can't predict a mind flood, right? Or
Yeah.
so if something in the real world changes the game, I think any UTAs out there who are watching this, let me know. But I think any reasonable TA will say, well, that was then, this is now. Not to quote John Maynard Keynes, but to quote John Maynard Keynes, if the data changes, I change my opinion. What would you do if the data changed?
Yeah, because TA is all based on, and I'm a big TA guy as well, but TA is all based on the past, and the past is finite, whereas the future is infinite. There's an infinite number of different possibilities, outcomes, etc. Where the term past performance does not indicate future results, right? You can apply that to TA as well. But yeah, I mean, to your point, there it
Well,
is.
hey, Sarah Connor told us that the future was not fixed. So there you go.
Yep. Yep. And to your point there, it is all about probabilities. So, I'm just going to pull up a random number. It's not based on any scientific study or anything, but essentially the idea is that if you run TA over, like, let's say 100 different trials, you see the same pattern, you might get it right 60% of the time than you would otherwise. So that 60% or that 55% edge, that's what gives you an edge as an investor, as a TA analyst. But there's going to be that 40 to 45% chance that you get it wrong as well. It's not a one size fit all. It's not going to be 100% foolproof. Nothing is foolproof in this world. But that's kind of the idea behind TA. One last question before we move over from uranium. So the miners have been moving up as well, but not to the same level as the metal itself. Why have the miners lagged behind the metal in a degree there?
Yeah, I think this is one of the things, one more thing where I'm not going to get any love from a lot of people, but the better miners have moved.
Yeah,
I
like
think this is
CCJ.
like if you look at the average, you're going to say, well, gee, the miners are underperforming. Well, the average includes all the moose pasture or grass cutter pasture or guanaco pasture or whatever out there, as well as the companies that have assets of demonstrable, measurable merit, that are going into production or are producing or are ramping up production. You put all that in one basket, and of course it underperforms. In particularly in a market that's tiny and really not on many people's radar until recently. The good news is that if you're a good stock picker, the better companies, the ones with the right stuff, they did great. They did not fail to deliver leverage to the underlying commodity. Um, and sorry, but yeah, I'm not sure I can say anything else
Yeah.
without being hurtful here. But if your portfolio is full of all the stocks that didn't move, you need to ask yourself some hard questions about your stock selection.
Yeah. Is this also a case of capital flowing into the bigger names first before capital flows into, let's say, the developers or some of the smaller cap companies? Isn't that the typical sequence of events?
It could be. Yeah, I think yes, I'll say yes. But I also think that there are some projects out there that are based on so much hopium rather than uranium, right? And especially early stage grassroots don't have a deposit yet, or maybe don't even have a drill hit yet. It's a close ology play or even a people play, but there's no actual uranium in the story yet. It's not surprising when some of those stocks underperform. People say bet on the jockey, not the horse. And my thing is, I get that, but I want to see the jockey and the horse. There's plenty of speculations for me to make. I don't need to throw my money all over the place. When I can bet on the great jockey and a horse that looks like a winner, why go anywhere else?
Yeah. Yeah. So let's go ahead and shift over away from uranium. I think that covers the space enough for now. most contrarian view that you hold at the moment, what would you say that is?
Well, contrarian for resource investors or contrarian for mainstream?
Let's say
You know,
resource investors. Is there like a sector or anything that people that are just completely hated, unloved, that you see some bullishness to it?
it might actually be lithium right now.
Hmm.
I think lithium, by the way, I wrote a lithium report. Well, actually, one of my guys named Sudarshan, he's a very brilliant guy on my team, uh, authored the report, did the research for it, and I helped him with the writing. But anyway, there's a lithium report, and we made, based on his analysis, which made sense to me, persuaded me, a bullish case for lithium after the recession. I was already worried about it's an industrial metal, what happens in a recession. And there are even some, recession scenario charts in there because the auto industry always takes it on a chin in a recession and usually takes a couple years to recover. So there's, but now there's sort of this pile on lithium of, well, there are these headlines about all these EVs not starting this winter. Chicagoans with their Teslas not being able to work, and other cars that didn't work in the cold, and so on. And Ford cutting back its Lightning F-150, and Hertz selling off their electric cars because they were expensive to maintain, and people didn't want to rent them. And so there's a lot of pushback on the EV story, and there's a lot of increasing hype, may not quite be the word yet, but enthusiasm for the hydrogen story, and that hydrogen cars are going to be the better option than electric cars. And by the way, you can burn hydrogen. There's hydrogen fuel cells, but you can also burn hydrogen in a conventional engine. You can adapt a conventional engine to burn hydrogen the way you can natural gas. So you don't have to retool the entire industry the way you do for electric cars. You don't have to worry about a number of things. But so where I'm going with this is it seems like there's a push and direction, even amongst the resource crowd, that, a lot of them hated EVs to begin with. They had all these government subsidies, were a bad idea. They shouldn't have been there anyway. So they hate EVs, and they want to believe that the EVs are done. By the time the recession is over, we're going to have hydrogen cars, or people are just going to buy gas cars again, and the EVs are toast. And therefore, lithium's never coming back. And by the way, I also warned people about nickel before the recession, and boy, was that right. But nickel, only a small part of it is part of the EV story. It's less sensitive to the EV story. Whereas lithium, it made a huge difference to the lithium market, let alone copper. Copper almost doesn't care about the EV story. I mean, it cares about electrification. And yes, there's more copper in an electric car, but copper is such a big industrial metal used in so many things that the EV revolution is much less important to it. Whereas for lithium, it's really, I won't say make or break, live or die, but it's a much huger impact on that market. So, sorry, I'm kind of being long-winded here. The point is that there's an increasing narrative that lithium may not bounce back after the recession because people are going to pivot back to gas cars. They're going to pivot to hydrogen cars, and or just the cost and reliability. There's just going to be a rich man's toy. The adoption isn't going to be there. I'm skeptical on this. I think that may happen over a longer period of time, but I think that the powers that be are going to let the money helicopters fly sooner. Like, we're not going to have a 2 or 3 year recession the way we normally do, if I'm right. They're going to throw so much money at it that, the moment it becomes clear that's what's happening, it might be like the 2020, very, very sharp V-shaped spike. So the money coming back now, and the hydrogen cars just aren't ready yet. They're not, I mean, you can find them in some places, but there's no hydrogen refueling station anywhere on the entire island I live on. I literally cannot buy one of those things if I want to drive it here. And there's other places where it's just not practical. So that's not ready yet. And, Tesla is working on lower cost cars. You can hate Tesla all you want, but they're working on that. And even if not, the Chinese are certainly doing it, right? So lower cost EVs that are going to compete on a price basis more with the gas cars are going to be there. And, the European Union in the midst of a war and a pandemic, did they pull back on their subsidies for green technology? No, they doubled down. They said this is all the more reason why we have to subsidize and spend more billions and trillions on the energy transition. So I think, a recession could actually be a good thing for the EVs. Not that it should be, but because the powers that be will throw more money at them. New tax incentives could easily be part of the economic revival plan of most Western politically correct nations. So what I'm saying is I wouldn't buy any lithium stocks today. They're laying people off. They're shutting down. There's blood in the water there. And I don't think the recession has done its worst. But if I'm right, and the recession gets the easy money treatment really quick, then I think we'll probably see lithium rebound. And I don't know long term how long that goes, because lithium is not rare. It's like, number 2 on the periodic table. Right? It's not rare. And high prices definitely are curing high prices now. So I'm not sure it ever goes back to crazy prices. But I think we're going to see a rebound in lithium. And I think that would be a surprise to a lot of lithium bears today.
Yeah. So battery metals, so essentially lithium is the most exposed to that battery metal sector out of all those other metals. Gotcha.
Yes. Well, cobalt possibly more. And again, cobalt, by the way, I don't think comes back, because cobalt is used in other things. But
right.
This is a big use case, and I don't have the numbers off the top of my head for that. But this is a big use case for cobalt, and it's even before the LFP batteries that have no nickel in them or cobalt. Even with the NCM ones, they're still looking to minimize the cobalt in there because it got pricey. So that's one where high prices were already working. And we're seeing the new, LFP is the lithium iron phosphate batteries that have no nickel or cobalt in them. The NCM or the nickel, I guess, cobalt manganese. I'm forgetting my terminology here. But even though there's no N in there, there's a lot of nickel in those NCM batteries and a lot of cobalt. And the change is already underfoot. Like the Chinese are all over this. Tesla's already producing more LFP cars. And the concerns people had about performance, there was hesitation before because the LFPs didn't charge as long. They had lower mileage per charge. But the more the charging stations proliferate, the less worry it is. And the new designs on these LFPs are almost on par with the NCM batteries. So it's no longer a big advantage. And by the way, they don't catch fire so easy. They recharge faster. They last longer. So there are actually a lot of advantages to these LFP batteries with no nickel or cobalt. So if you take cobalt off, nickel it's not. It's like copper. It's used in making steel. It's used in making so many other things that, the battery tailwind matters to it, but not as much as lithium.
Yeah. Yeah. So far we've touched on economic recession likelihood. We've looked at uranium. We've looked at battery metals, lithium in particular. So if I were to give you, Lobo, let's say like $1 million and very broad strokes, how would you allocate that $1 million?
Well, does it all need to be allocated like right now or over this year?
Let's say right now, given current economic conditions, how would you go about allocating that $1 million?
And am I allocating it for gains primarily or almost exclusively? Am I maximizing return, or am I concerned about safety? And am I looking for a barbell here, or am I 19, no kids, or 90, all grown up kids looking to swing for the bleachers? Sorry, but this is part of the answer to the question. Of course, one size doesn't fit all. So what size am I here?
And this is a valid question for the audience as well, because you see what Lobo did there. You can't just take hot tips from experts indiscriminately, because your situation is different from their situation. And that's one of the things that Jim Rogers told me when I interviewed him. Taking stock tips. You can listen to people, but at the same time, you've got to make judgment based off of where you are. So let's say to maximize gains, Lobo, how would you go about allocating that portfolio?
Okay, if I'm allocating right now to maximize gains, then I'd probably split it 50-50, gold and uranium. And then I would, even with maximized gains, I still don't want to wipe the money out. So I would do a barbell approach within that. The barbell would be maybe a third into some of the blue chips, the larger, less risky plays. I won't name names. Everybody probably knows who they are. And then swing for the bleachers with the other 2/3 on juniors, but even, or smaller companies, even there, I would be judicious because I really hate losing money. So I never bet on grassroots exploration unless it's a prospect generator. That's the only way I'll bet on pre-discovery exploration because it's just too risky.
Gotcha.
So if I'm looking for capital gains this year, I would go first barbell, some of the safer ones, and then I'd move down the food chain to the juniors that are building mines, and then I'd look for what I call success in progress. Right, it's not just, oh, here's our target. It's, we're drilling this puppy off, right? Yeah, I'd probably stop there.
Gotcha.
So it would be successful exploration plays. It would be developers that have all their ducks in a row on the small end of the barbell, and then the heavy end would be the major players that are delivering to the bottom line. They're not problematic. They're not having their geologists shot up in some revolutionary place. That's how I would split it. So it'd be 50-50 gold and uranium, right? It would be anything else. No oil, no lithium, even we were talking about as a contrarian bet. I love copper, but no, none of those things until after the recession.
Yeah. Yeah. So gold and uranium, the two yellow metals, could keep going back to those two metals there.
For this year, I'm
yeah,
not
for this.
I'm not a broken clock on that. I will change my lineup depending on, my outlook.
Mm-hmm. Yeah. And to kind of piggyback off of what we just talked about in terms of investing in what investing in your circumstance, not necessarily people that I kind of wanted to get your take on what you see in the immediate term, how you would kind of maneuver around that. But broadly speaking, what are some of the biggest mistakes you see investors make in general?
Boy, where to begin? Well, when I do workshops on this, one-on-one workshops, I always start with know thyself. And I know it sounds like pop psychology and a bit mushy, and people want a spreadsheet that tells them what to do. But I really think it's crucial to have a good talk with yourself, look in the mirror, and ask yourself, what kind of investor are you? What is your risk tolerance? Can you really, be honest with yourself? Can you buy something, see it go on sale 50% off, and buy more because nothing has changed other than the price? And if the answer is no, you really need to take that under advisement. So, if you're on a fixed income and you really can't afford to lose your nest egg, you should keep that in mind. If you're my proverbial 19 or 90-year-old who with no care in the world, because it doesn't matter, you've got a different risk profile, you've got a different appetite, and that's fine. You need to know who you are. The other thing is, and it still sounds mushy psychological, but we're getting more specific, is, what are your interests? If you're a big fan of nuclear energy, for example, and okay, I'm talking uranium a lot, but, if you like that idea, if you're enthused by, the vision of the future, what would the world be like with, abundant, low cost, clean energy 24/7, right? What you're excited by that. Well, you know what? Your natural interest will, you won't fall asleep reading company reports because the whole thing will interest you. Or let's say you're, beyond the resource, or let's say you're a gold bug. You're fascinated by gold. You love to go with a metal detector, or finding rocks in the, go with it. That's what interests you. You won't, again, fall asleep reading these company MD&A reports and so on. You need that. So basically the idea is you want to develop your own expertise. And, it's very complimenting. It's flattering if people say, oh, Lobo, I trust you. I'll just follow you. But if you do that and the stock goes on sale and you're not really sure why, you just followed me, that's a pretty scary time. Whereas if you studied it, you got familiar with the company, you called management,
You know the
read
why.
reports,
No.
right? Yeah, you'd say, there's nothing wrong with this. This story is better and cheaper. I'm going to buy more. And if you don't know that, it's like, something's wrong, right? So I really think that if you can't get enthusiastic about whatever it is you're studying, like these Bitcoin maximalists, they're all over that. They can't read enough about this stuff. That kind of enthusiasm, find what interests you. And by the way, it's not just resources. I don't know anything about biotech. I like the idea because you have these sort of binary outcomes. It's like a discovery. Well, actually, you might discover actually something new in biotech. But even beyond that, an FDA approval is sort of like, that first part of the Lassonde curve. So, I like that idea. It's very similar to what I do as a resource speculator, but I know nothing about that. And frankly, the idea of studying and learning about the chemistry and everything that goes into understanding the CRISPR thing is like, for example, people talking about these CRISPR technology. I don't understand that. And I'm not excited about learning about it, right? So I'd rather stick to my knitting. And by the way, this is a key point. I don't tell anybody buy only gold and uranium, don't do anything else, or buy only metals and mining stocks, don't do anything else. I'm a due diligence guy in this area because that's my expertise. I'm here not to tell you don't do anything besides what Lobo does. I'm here to tell you for that part of your larger portfolio, you've got real estate, you've got biotech, or you've got whatever else you've got. But this part and allocation to extractive resources, commodities, metals and mining, I can help you with that due diligence. So I'm not sure if I'm really helping very much here, but I do think these psychological factors are a big part of the mistakes that investors make. I guess maybe another one, a pet peeve of mine, is that I joked earlier on with that Monty Python quote, only a model. People love models. I have an essay, you can look for it on the website. It's called The Adventures of Spreadsheet Guy. And I hope the person that inspired this doesn't know who I'm talking about because it's not very flattering. But I actually ran into somebody in Africa, like literally traipsing through the jungle with a laptop computer open, punching in guesses into the spreadsheet. We're looking at a project that I think had less than 6 drill holes in it. And he's already filling out a model for how big the pit might be, what the pit wall might be, what the rock hardness might be. He's asking the geologist, well, what do you think the specific gravity is going to be? And they don't even have a deposit yet, let alone know how big it is, let alone know, they don't know anything about this. So you put a bunch of guesses into your spreadsheet, and what do you get out? A guess based on guesses, based on guesses. It's ridiculous. But people love that. You get these brokerage reports and they all have price targets. We're initiating coverage on XYZ Moose Pasture Co. And our price target is, 351, not 350, not 360, 351, a year from now. Like, who the hell knows that? Nobody knows that. And the guesses that they make, and this is why it's my pet peeve, is it's not just, oh, well, they're wrong or something. Like they give you this phone book size report. It's full of math and charts, and it looks authoritative. It looks like they really know what they're doing. Wow, they really studied this. Wow,
They overwhelm you. Yeah.
That thump factor of the the thud of that report landing on your desk is very persuasive, and I think that's dangerous because it makes people more confident than they should be. They forget they're speculating. They look at this phone book size report. They think they know something about the future. They think, well, all those bright guys in New York and Bay Street in Toronto, they know it's going at 351 and it's only 121 now. So woohoo, I'm going in. And people will make bigger bets than they should with, I think, excessive confidence. I'll get more Rotten Tomatoes thrown at me. I'm just saying, I'm not afraid of math. It's not, I'm not a mathophobe, but beware of people that throw models and numbers at you that really, it's just a glorified guess. No matter how much math you throw at a guess, if it's still a guess.
Yeah. It's the map, not the territory. It's never going to be the territory.
That's right.
So this has been a fantastic talk, Lobo. I really enjoyed this. Any concluding thoughts before we sign off?
Yeah, well, you asked me about deploying right now. I think despite what I said about uranium being, uh, still likely to correct, it's past the, or possibly correcting. Uranium also has, I think, more potential to take off in the near term than gold. I see more headwinds in the near term for gold. We had bad news out of the EU. Retail sales were down again. And so, okay, if the commercial real estate thing blows up in the US next week and the Fed does a sudden screeching pivot, then that's bearish dollar, bullish euro, bullish gold, other alternatives to dollar. That could happen, but there's nothing that really makes that seem likely to happen right away. Whereas the deterioration in the EU, the trouble in Germany, the problems they have there, other things being equal, the way things are looking now, I think the ECB pivots before the Fed, or rather, I think the ECB cuts before the Fed. And that would be bullish dollar, bearish euro, bearish gold, or other alternatives to the dollar. Not forever. The Fed will catch up. The race to the base, one horse gets ahead in the race a little bit before the other. But at the end of the day, they're both debasing, right? And that's good for gold. So what I'm saying is, both could go down in the near term, but this Kazatomprom thing, I think, may have put a floor under uranium, and the flavor of the day thing could make uranium take off sooner than gold. I'm bullish on both this year, but I think there's a higher likely of buying opportunities in the gold space in the weeks and maybe the next couple months ahead.
Gotcha. So bullish on gold, but
looking for buying opportunities.
And then lithium as well. Not necessarily buying now, but you've got your eye on lithium.
Well, that's my post recession. I wouldn't say I buy lithium first. You asked me for a country. I think there's people that want lithium left for dead, and I think that would be a mistake. But post recession, yeah, I will probably look to deploy into some of the better lithium plays. Absolutely looking at copper. Nickel, not so sure. If it continues to sell off, if it gets really oversold, I could go there too. But longer term, of all the, it's not just a battery metal, but of all the industrial metals, my favorite is absolutely copper. I see that again as a multi-decade bull.
Yeah. Well, fantastic talk, Lobo. Really enjoyed it. Thank you so much for your time. If you enjoyed this content, be sure to give us a like. Comment down below, what do you agree with? What do you not agree with? I'll try and respond to every comment. We'll have a conversation. Also, subscribe to the channel if you haven't already. And Lobo, where can people find you?
IndependentSpeculator.com. I've got a free weekly newsletter called the Speculator's Digest. And I can't promise to be right about everything, but I will promise that if you sign up, we will not spam you with a flood of daily advertisements. I hate that. You get one email per week, and you could see if you like my way of thinking.
There it is. Well, you heard it yourself. So go to independentspeculator.com, the URL right on top of Lobo's head right there. We will also have it down linked in the description box below. So be sure to check that out. And I will see you in the next episode, guys. Bye, y'all.